lots of you are excited to learn about investing. I just want to let you know that today is going to be a very basic introduction. I have some prepared remarks, and then I will pause at the end and scroll back through the feed to see if there are any additional questions, just because sometimes it gets a little disjointed and distracting if I'm trying to pay attention to all the comments while I'm also talking and answering questions. But the reason we're doing this is because one of the most common questions that I get asked is how to start investing. We just completed a couple weeks ago, for those of you who are new, a 10-week series about how to analyze an individual stock and whether an individual stock is the right investment for you as a retail investor. And we started with that because when you talk about investing, stocks tend to be kind of the first thing that comes to people's mind, even if you don't really know that much about investing. But two things I think that came out of that series for most of you is you'll realize that the average retail investor, and that's people like you and me who aren't doing this professionally, really doesn't have the time or the ability to analyze individual stock names to make them to make good investment decisions that are competitive with a full-time analyst who, for instance, is backed by a bank or backed by a hedge fund and has unlimited resources at their disposal to do research, and it's their full-time job. So this makes investing in individual names much riskier for the average individual investor. So that might leave you asking, then how can I invest and access equity market-like returns? So many of you also then want to understand at an even more basic level, how do you even get money from, say, your savings account to somewhere that you can make investments and even access the market? So that second question about, how do you even get started and set up, that's what we're going to talk about today. How to start investing if you've never invested before. I'm going to cover investment accounts that many of you may already have in place, as well as what's available and accessible to everyone. And then in the coming weeks, we'll dive into additional topics that include things like understanding the relationship between risk and return and how you think about those two things, how to understand risk appetite. So for those of you who may already use a 401k, when you look and it talks about like aggressive versus moderate versus conservative and your eyes kind of glaze over, we'll talk about what those different things mean. And then back to that first question I mentioned, how do you invest without investing in individual stocks? We'll talk about kind of different products that are out there, things like mutual funds, index funds, and ETFs. And we'll also talk about different asset classes. So most people think about stocks, which are equities, but there's also an actually even bigger part of the investment world that is debt or bonds. And then there's things that are different even from that, like commodities, which would be things like oil and gas or gold and things like that. I'll pause for just a second. One thing that I want to clarify is I am not a registered investment advisor. I am not affiliated with any sort of brokerage. I have a degree in finance, and I used to work for a hedge fund doing investment research. So that's kind of my background and experience. But because of that, you'll never hear me recommend a specific stock to invest in or a specific fund to invest in, just because I am not registered and licensed to do so. So just that's my little disclaimer for everybody. And then the other thing that we'll talk about when we're talking about investing is what to watch out for and be aware of. And for most retail investors, the big thing to be aware of is fees. And then making sure you're matching your investments to your risk and your time horizon. So that's kind of the outline as to what we'll cover over the coming weeks in total. But today's topic is really how to start. So today you might be sitting on some money in a savings account and you want to invest it, but you're not sure what to do next to actually make an investment and access the market. In order to do that, and I have a little diagram. I'm going to see if I can turn this around. Your money has to go into an account that gives you market access and allows you to put your money at risk in order to earn a greater return. So what do I mean by that? So right now your money is in a savings account, and a savings account doesn't do that. Savings accounts that are with banks that are FDIC insured means they're backed by the federal government, and your deposits are guaranteed and not remotely at risk for up to $250,000. So if you don't take any risk, you don't have any return. And the bank is just going to pay you a small interest rate for your deposits. So in order to get greater returns, you have to move your money into an investment account that allows you to take risk. And there are two different types of investment accounts that you can consider in order to access the market. So here's your money. You're going to put it in an investment account, and there are different types. You can either invest in via taxable accounts or tax sheltered accounts. A taxable account is typically called a brokerage account, and we'll talk about that more in a second. But the brokerage account has little to no limitations in terms of annual deposits, withdrawals, or what you can invest in from it. So it's going to give you the greatest flexibility, but the downside is it's taxable, which means that any gains you make, so when you buy a stock and you sell a stock and you quote unquote, we'll call that realizing the gain, you'll have to pay taxes on at the end of every year. So you'll have the greatest amount of flexibility in terms of what you can do with it and how much money you can put there, but you're going to lose a chunk of it every year to taxes. Tax sheltered accounts are things like retirement accounts. So for many of you, that may be a 401k. If you work for a not-for-profit, it might be a 403b. And then individuals, and we'll talk about these more in a minute, can use things called an IRA, an individual retirement account. And then other tax sheltered accounts are things like 529 plans or college savings plans. These accounts, the tax sheltered ones, allow you to make contributions so you can move your money into them. And sometimes you can do that before taxes, so it saves you on taxes, and some might be after taxes depending on the type of the account. But the benefit is that all the money you make when you invest from these accounts continues to grow. We call that compounding, tax-free. So you don't pay any taxes on the gains until you withdraw them. And that might be once you get to retirement or when you go to pay for college. And in the case of a college savings plan, the gains are taxed, or you never pay taxes on as long as they're used for educational purposes. And so you can see kind of the advantage to using a tax sheltered account for investment. But there are limitations. There's limitations in terms of how much money you can contribute every year. And we'll go into that in a little more detail in a minute. But once you have money in these accounts, you then can use them to drive into the market and to put it into investment vehicles. And even though the lines are here, like from any of these, you can access any of these with some exceptions. But when you get to this point and you have your money in an account and now you're going to access the market, you have another decision to make. What type of vehicle do you want to use to access the market? So what most of you might be familiar with is that you can invest directly in things like stocks or bonds. Those are direct investments. You're having direct ownership in a company or you're directly holding a company's debt. That's a direct investment. What many people may be less familiar with are what are called pooled investment. And a pooled investment kind of is like what it sounds like. Your money is going to be pooled or combined with other investors inside of a fund. And those are things like mutual funds, or there's also exchange traded funds and index funds. And I'll talk about each of those in greater detail next week. But when you put your money into a pooled investment, the fund then invests from here into these direct securities or even other pooled investments. And your investment tracks the performance of the overall pool. So why might you want to use a pooled investment? Using a pooled investment gives you as an individual investor with perhaps a small amount of money, it gives you the access to broader market exposure and different investment strategies with far less money than you ever could access as just an individual. So I'm going to for a second, since we're done with the diagram. So as an example, you might want to mimic as a moderate investor, you might want your performance to look like the market performance generally. The way many people do that is by buying an index fund that tracks the S&P 500, which is kind of a general market indicator for the US market. If you tried to replicate the 500 stocks and the weighting of them in the S&P 500 all by yourself, it would cost you literally millions of dollars. But you can buy an index mutual fund that gives you the same exposure for just a few $1,000s, or even just one share of an exchange traded fund for the price of that ETF. And right now, the best S&P ETFs currently trade around $300 a share. So that very clearly shows you the benefit of using pooled funds like mutual funds or index funds. Okay, so now that you kind of have this roadmap for where to put your money and how do you start to think about the decision on what type of account to use and what vehicles to use? I highly recommend starting with tax sheltered plans, and ideally starting with your retirement account. Based on data that's out there from the IRS, the vast majority of income earning Americans have access to and participate in a retirement plan. If not themselves, they have access to one via their spouse. Not that they can invest, but their spouse can invest. As of the latest data, which was from 2012, 63% of all taxpayers ages 26 to 64 participate in a retirement plan. And the older you are and the more money you make, the more likely you are to participate. So if you are just starting out, this is where I recommend that you begin. And here's why. You can make investments on a pre-tax basis. So instead of investing after paying taxes, and you're left investing 60 to 80 cents on the dollar, you're investing full dollars. And this pays off in a really big way, not just today by saving you taxes, but over time as your returns compound. And what do I mean by compounding? It basically means that when you put $1 in today, and over the course of this year, say the market returns 10%, at the end of the year, you have $1.10. If next year it returns 10% again, your return is on $1.10 times 10%. So it grows and grows. That's the compounding effect. And so by having more to invest up front, your compounding is greater in every subsequent year. So say you invested after tax today and your margin, and say you paid 40% in taxes, you'd only have 60 cents to invest. And over 20 years at an average return of, call it 7% a year, that's $2.32. If you instead invested pre-tax and invested $1, the entire dollar, at the same rate of return for the same number of years, you'd have $3.87, which is almost a 70% increase, all from just investing on a pre-tax basis. The other reason to start with your retirement plan is that many employers contribute to your plan on your behalf, and they do it in a couple different ways. Many do it by matching a percentage of your own contributions. So if you aren't contributing to your plan on your behalf, you're losing out on free money from your employer for your future retirement. So that's a benefit that a lot of people have, and if you're not making contributions for yourself, you're losing out on that match. Another thing that employers do is sometimes they offer profit sharing, and they do it through the plan. So if you are not using your 401k, you're losing out on that too. So you're basically losing out on free money. So for those reasons, that's where I want you to start if you are just starting out. And that may be you're using a 401k, a 403b, which is the same thing as a 401k. It's just what not-for-profits and things like government jobs offer, or an individual retirement account. And there's also something called a Roth IRA. And we'll talk about kind of the difference between all of those at a future date. But what I want you to do is, one, you need to participate. So if you're not already participating and you have access to any of those, to a 401k, do that. If you don't have access to a 401k, anyone can set up an IRA. It's almost exactly like setting up a brokerage account. You're just ticking a box that says it's an IRA and you get tax benefits for it. So you need to increase participation first. And second, you need to increase your contributions. In 2013, the annual 401k contribution limit was $17,500. Today, in 2019, it's $19,000 a year, and the average employee contribution was less than $5,000. So people weren't taking advantage of both the ability to shelter their taxes and then save for their future retirement. And it's really important that we do that, because and again, it's the magic of compounding. In 20 years, if you only put in $5,000 at 7% return a year, you'd have just under $20,000. If you max out that contribution, that $17,500 at the same return over the same time period, you'd have almost $70,000. And so when you're thinking about wanting to retire someday, $70,000 might be enough to live on for a year. $20,000 is probably not. So again, if you don't have access to an employer-sponsored plan, you can still save for retirement with an IRA or a Roth IRA. And so if you're a stay-at-home mom, if you're a solo entrepreneur, and even if you just have like a side hustle and you want to be saving for the future, an IRA is accessible to you. Somebody also had asked about if you're self-employed. There is something called a solo 401k, which you can set up if you're self-employed, but it literally has to be like just you and your spouse. You can't extend benefits to, if you have any employees at all, you actually have to have a full 401k plan. So literally anybody can take advantage of these tax sheltered accounts, whether you have an employer sponsored plan or you open up an IRA on your own. Okay, so let's talk about the downsides of these tax sheltered accounts. If this is the route I'm recommending you go, what are some of the downsides? The biggest is that they have an annual contribution limit. But given how little people are contributing already, kind of maxing it out may be a stretch for most people, and that's okay. If you've reached the annual contribution limit, only then would I recommend using a taxable brokerage account to invest. And just as a reminder, the contribution limits for 2019 on a 401k is $19,000 of your pre-tax income, and for an IRA, it's $6,000, and those are individual limits. So if you and your husband wanted to have an IRA, you could each put in $6,000. Another downside, most tax sheltered accounts are overseen by an administrator, and that administrator often limits and sets the investment options and limits them to a specific set of funds. And often those funds are managed by the same administrator. So as an example, you might have a 401k that's administered by Fidelity, and they give you as choices 30 to 40 Fidelity managed funds to choose from. Fidelity is a very highly regarded investment manager and has been around for a long time, but it's just a limitation to be aware of. You're not going to be able from your 401k to buy individual stocks typically, and you're also not going to be able to kind of go out and buy anything and everything. You're going to be limited to a set of choices. If you open an IRA, it typically has a little more flexibility to invest in individual stocks, as well as things like exchange traded funds and index funds, and it's more like a brokerage account. If you are interested in opening a brokerage account, so if you've maxed out your tax sheltered contribution limits, or maybe you just want to have a little money on the side to learn a little more about investing and you decide to open a brokerage account, you can pretty much do it at almost all of the major banks. So Bank of America, Citibank, JP Morgan. You can also do it at investment firms like Vanguard, Fidelity, and even some of the online apps and things like that, like E-Trade. All of those are places where you can go and open a brokerage account. A couple things that I want to make you aware of and consider before you choose where you want to put your brokerage account. One, some may offer you the choice of opening a cash account or a margin account. Unless you are an investment expert, I highly recommend using a cash brokerage account only. A cash account just means like what it sounds like. You put the money in and that's the money you have to invest with, and it's very straightforward. Margin accounts are a lot like gambling with borrowed money. And it can be extremely dangerous if you don't know what you are doing, because you can end up taking positions that are far larger than you intend. And then the bank comes and says, oh, your position declined, and now you need to put up way more money than you ever thought you were actually playing with. So for beginners, I would just recommend using a cash brokerage account only. The other thing that you should consider is the financial strength of your broker. And what do I mean by that? Unlike a savings account, which is FDIC insured by most banks, meaning that if the bank were to go bankrupt and be gone tomorrow, the government guarantees your deposits. The same is not true for accounts or brokerage accounts. There is something called SIPC coverage, and it's sort of like a pooled insurance policy for brokers who choose to participate. And if your broker is an SIPC member and they were to go bankrupt, that organization would park your investments in an account until all of the dust settled, and you wouldn't lose your investments because your investments are in an account and they're still actively trading. And just because the bank itself went bankrupt, you didn't lose those. But it's just a little messier, and it's not as straightforward as the government guaranteeing them. So you want to make sure that you're parking your money somewhere that, they're going to be around tomorrow or 10 years from now. There is a website called brokercheck.finra.org. FINRA is a regulatory body that broker-dealers and registered investment advisors have to register with. And so you can check. And also, if you're looking at financial advisors, you can check to see their registration there too. So that's a good place to look. And again, that's brokercheck.finra.org, FINRA.org. The other thing you should be aware of is, are there account limits or minimums? Do you need to maintain a minimum balance in order to not incur fees? And are there things like minimum trade sizes? Because that may impact, your ability to invest depending on how much money you have starting out. The single biggest thing that I want to warn you about if you're looking to open an individual brokerage account is fees. You need to understand what the broker will charge you for trading, which is sometimes also known as a commission. When you are a really large institution, like when I worked at a hedge fund and we were taking equity positions, we were buying millions of dollars worth of shares at a time. And when you do that, you do pay a commission, but it's not like a set fee. You often pay a spread, and it may be like a penny or a fraction of a penny per share. But for smaller retail trades, the broker typically charges a fee per transaction. And this can be really significant relative to the size of your trade and the frequency of your trade if you're trading daily as opposed to buying an investment and holding it for a long period of time. And it doesn't vary. Usually the fee is the same whether you're buying 10 shares of a $4 stock or 100 shares of a $400 stock. And it can range depending on where your account is, from free to $8 or more per transaction. And if it's something that you might require broker assistance with, it can even be as much as like $25 or more per trade. So that's just something to consider, that if you're trading in small dollar amounts, that can really impact your return. And also if you're trading frequently, those can really add up. So just be aware of what the fee is going to be to trade. Another thing to be aware of, and I get asked about this a lot, so I wanted to make sure I touched on this and really emphasized it. If you are using a no-fee trading account, people ask me about apps like Robinhood and others all the time. Here's what I want to tell you. No firm can operate without revenue, right? If they're not making money, they're not going to exist. And if they're not charging you a fee to trade, you need to understand or do some research into how they are earning revenue in order to, continue to exist. Excuse me. As a specific example, Robinhood is rumored to be going public this year, and most recently was valued at over $5 billion. So clearly they're making revenue somehow. And these are just some quotes about them from a Wall Street Journal article. So Robinhood makes money in part by sending customer orders to high frequency traders in exchange for cash. So what does that mean in English? It means that they're taking the information from all of their customers and the trades that they're putting on, and they're selling it to hedge funds there's a type of investment style that's called high frequency trading. And basically they use that information to determine the positions that they're going to put on. And in effect, because they may have closer physical proximity or faster connection speeds to the market than you, they may even be able to trade ahead of you. And so what that means for you is that it may cost you more per share, even if it's not by way of a commission or a trading fee, simply because they're selling out your information. Many brokerage houses do this. However, most are more transparent about it, and most credit it back to the person in some way by reduced trading fees. It's definitely a controversial practice, but it's called payment for order flow. So just to be clear, that other brokers do this too, but Robinhood this is basically their entire business. So chances are, while your trades are free, you're trading at a slightly worse price than you might trade elsewhere, costing you more. And so if Robinhood is something that you're using, it's not a bad option for a small investor, but just be aware that that's what's going on. And if you're someone who trades really frequently and is in small trading increments, that having no or a free trade policy may be to your benefit. But if not, you're likely better off elsewhere. And I'm happy to share that article for people who are interested in learning more about it. The other thing that I want to make people be aware of is that if you're trading in small increments or in partial shares, like there are some, is it Acorn that allows you to kind of like save in small increments at a time and invest for you. And then I've also seen some like companies that have asked me to review apps and stuff that are for things like allowance for kids, where they allow the kids to save money and invest. And it might allow them to invest in like $5 increments at a time or buy partial shares. Anything that does something like that, there's usually really, really big fees associated with it, to the point where like those fees are going to negate any potential return you might make. So just, again, something to be aware of. Understand the fees associated with your account and the trades that you're making from your account. So if you want to start investing, just to recap, you want to start by maxing out your contributions to your tax-sheltered options. So your retirement accounts, your college savings accounts, and only then should you really look at a taxable brokerage account. Next week, we'll talk about how to then decide exactly what to do with that money. So we'll look at the basics of different types of assets, so stocks, bonds, and cash, as well as examine what different types of pooled investments are and how they work. So why you should consider them over individual stock picking. And those are things like mutual funds, ETFs, and index funds. And I'll also briefly touch on a few other things you may hear about, such as commodities. I also got some questions about what options are. Those are called derivatives. And just so that you can understand what they are. And then someone also asked about annuities, so I'll touch on those next week as well. The following week, once you understand kind of all the different investment options, we'll talk about risk versus return and your personal risk appetite, and then kind of how you put all those things together in order to, choose what your investment portfolio is going to look like. And we'll talk about what it actually means to be conservative, moderate, or aggressive. If there's something about investing that you'd like to see me talk about on an upcoming Market Monday and it doesn't fall into one of the areas I just described, feel free to shoot me a DM and we can add it to the agenda for a coming week. And I appreciate you guys all listening in today. I hope you learned something. If you have questions about anything I talked about, feel free to shoot me a DM. And otherwise, I will see y'all next Monday. Thank you. I'm glad you found it helpful, and I'm glad we can all learn a little during nap time. It's nap time here at our house too. So have a great week, and I'll see you guys next week.